For a broader take on the markets, let's bring in Brenda O'Connor Juanas. She is a senior vice president and financial advisor at UBS. Happy New Year, Brenda. Nice to see you. Always appreciate your time. And I'd love to just start with this narrative that has been driving assets higher, it feels, in these first couple of weeks of the new year. What's been your reaction?
Absolutely, John. Thanks for having me back. Well, let's talk about first impressions. And investors have to be happy with what they've seen so far in 2023. We've had some good economic data on the jobs front, particularly around wage growth. We saw inflation numbers last week at 6.5%, better than the previous month. And you're right, markets have responded accordingly. The TSX is up, S&P is up 4.6%. We've seen European equities up almost 8%. Now, I do think investors have learned their lesson from last year. There's not a ton of conviction behind this price movement, which is smart, but 2023 will be different. There's going to be different drivers slightly, and we can talk about what that means in terms of both positioning and opportunities for investors.
Let's get right into it. Go for it.
Right. So I think the markets were maniacally fixated on two things last year. It was about the Fed and it was about inflation. And of course, these things still matter. Powell is still the most important person in the room, but growth is going to be a big driver. And by growth, I mean both GDP and corporate profit growth. Now, remember that those rate hikes work on a lag. We haven't seen the full brunt of 425 basis points of hikes last year, and these have to work its way through the earnings. We saw this a little bit yesterday. Q4 earnings started last week. So what we need to expect is for that top line revenue growth to compress, profit margins should normalize, and EPS, unfortunately, will come down, according to UBS, by up to 3%.
So against that backdrop, walk us through how you're positioned now and what you're going to be watching that might determine your positioning through the year.
Right. And so we're not getting too excited with this price movement. Again, the data is slightly mixed. We don't expect a sustained economic or market rally at this point. So we're still defensively positioned, which means healthcare and consumer staples. And think about it this way. If growth decelerates, which it will, these are going to be resilient sectors. And think about it in the fact that people and consumers are less likely to drop their medical expenses, less likely to drop their household essentials. Now, I will say that these sectors are not cheap. They're trading at 18, 19 times forward earnings, but what they will offer investors is resilient earnings.
Now, I also noted, we showed for our television audience some of the different calls you're anticipating for this year, where the equity market perhaps ends, but also on the currency front, you're going to be keeping an eye on the Canadian dollar. How come?
Right. And this is important for all our global investors, but also pretty interesting for Canadians. So, we think that in terms of this multi-decade US dollar strength, we're getting close to the peak here. And really, that's on the back of the fact that the Fed is getting at least closer to their tightening cycle. US dollar CAD was up over 6% last week. And so as risk appetite comes back on, we saw it earlier this year, we'll hopefully see it with growthy names later in the year. That's going to benefit currencies like the Aussie dollar. It's going to benefit the CAD. So we're talking to our clients, predominantly our Canadian clients, about really taking profits on their US dollar gains, converting back to CAD at 134, 135, and then participating in the upside from there. So that could be a pretty interesting trade for both Canadian and global investors. And
then in terms of the biggest wild cards, I mean, certainly nobody could have predicted how things played out in 2022, especially on the geopolitical front. But what are you going to be watching for that might be a consideration for anyone who thinks that maybe the tide is turning for equities?
Right, and risks are something we always have to look at, and our core scenario is 4,000 on the S&P by the end of the year. We do think that the Fed's fund rate will become closer to the 3%. But last year taught us that markets are incredibly fragile, and that all it takes is Ukraine or a UK mini budget to dislocate and destabilize things. And there are a lot of things here that could shake up the markets. We could see an error from a central bank. We could see an acceleration in Ukraine. Frankly, the two things that are keeping me up at night are, number one, increasing U.S.-China tensions, and number two, just what the U.S. is going to do with things like, for example, increasing that debt ceiling, which is happening soon with such a fractured and split Congress, which is what we saw in the last few weeks when they tried to swear everyone in. So those are two risks that I think are pretty real for investors to keep on the periphery. All right.